What if I told you that I've discovered 3 simple investment funds that could generate $15,000 every single month in passive income? Imagine having no boss to answer to, no deadlines breathing down your neck, and no more trading your precious time for money. Just consistent income flowing into your account automatically while you're sleeping, traveling the world, or spending quality time with the people who matter most. Today, I'm sharing with you the exact 3 ETF strategy that has the potential to replace your full-time income with $15,000 in monthly dividends. I'm going to walk you through real numbers, real funds, and a real roadmap that everyday investors like you and me are using right now to build genuine financial freedom. But let me be crystal clear from the start. This isn't some magical get-rich-quick scheme that promises overnight millions. What I'm sharing with you is a legitimate wealth-building strategy grounded in proven dividend investing principles. The 3 ETFs I'm about to reveal are battle-tested, backed by billions in assets, and engineered to do one thing exceptionally well: pay you consistent, growing income year after year. So what are these 3 powerhouse funds that I've incorporated into my strategy? I'm talking about SCHD, JEPI, and VYM. Each one brings something unique and powerful to the table. Think of them as the 3 pillars supporting your income empire. SCHD delivers dividend growth that increases over time. JEPI provides high monthly cash flow that hits your account like clockwork. And VYM offers rock-solid diversification across hundreds of America's best dividend-paying companies. Together, they create a portfolio that balances income, growth, and stability in a way that no single fund can achieve on its own. Now, here's what makes this approach so compelling. These 3 ETFs aren't just randomly chosen favorites that happen to trend on social media. They're strategically selected to complement each other perfectly. When you combine them in the right proportions, you create a dividend-generating machine that produces reliable income while simultaneously protecting you from the wild swings of market volatility. Let me introduce you to the first pillar, the Schwab U.S. Dividend Equity ETF, with the ticker symbol SCHD. This fund has achieved legendary status in the dividend investing community, and I can tell you from my research it's earned that reputation. SCHD tracks an index of high-quality dividend-paying stocks that have consistently increased their dividends for at least 10 consecutive years. We're talking about companies with serious staying power, companies that have weathered recessions, survived market crashes, and pushed through economic uncertainty while still rewarding their shareholders year after year. SCHD currently yields around 3.8% annually. Now, I know what might be going through your mind right now. 3.8% doesn't sound like much compared to some other high-yield options out there. But here is where the real magic happens. SCHD's dividend has grown by nearly 6% annually over the past several years. This means your income doesn't just flatline, it grows. Every single year you're getting paid more than the year before. That's the incredible power of dividend growth compounding over time, working in your favor. The expense ratio on SCHD is remarkably low at just 0.06%. Let me put that in perspective for you. For every $10,000 you invest, you're paying only $6 per year in fees. Compare that to actively managed funds charging 1% or more, and you're saving hundreds or even thousands of dollars over time. Those savings don't disappear into thin air. They go directly into your pocket, accelerating your journey toward wealth and financial freedom. But what really sets SCHD apart from the crowd is its focus on quality over quantity. This fund doesn't just chase the highest yields blindly, it focuses on fundamentally strong companies. The companies in SCHD are evaluated based on cash flow strength, return on equity, dividend growth rate, and dividend yield. This rigorous screening process ensures you're investing in financially healthy companies that can sustain and grow their dividends for decades to come. We're talking about household names you know and trust, like Chevron, Merck, Pepsi, and Texas Instruments. These are proven winners with track records that speak for themselves. Now, let's move on to the second pillar, the JP Morgan Equity Premium Income ETF with the ticker symbol JEPI. This fund is what I call an income powerhouse. This fund currently yields around 8% annually. And here's the kicker. It pays dividends every single month. Let me emphasize that again. Every single month, JEPI deposits cash into your account. No waiting around for quarterly payments. This is monthly income you can count on, almost like receiving a regular paycheck. JEPI uses a unique and sophisticated strategy that combines equity investing with an options overlay. Essentially, the fund invests in high-quality, large-cap stocks and then sells covered call options on those positions to generate additional income. This strategy allows JEPI to deliver significantly higher yields than traditional dividend ETFs while still maintaining exposure to blue-chip companies like Microsoft, Alphabet, and Nvidia. Over the past year, JEPI has paid approximately $4.72 per share in dividends. If you own 1,000 shares, that translates to $4,720 in annual dividend income from this single fund alone. And remember, that income arrives monthly, giving you consistent cash flow to cover expenses, reinvest for growth, or simply enjoy life on your own terms. The beauty of JEPI is how it smooths out the volatility that often comes with equity investing. While the market might be swinging wildly from day to day, JEPI's option strategy helps cushion those ups and downs, delivering more predictable returns. This makes it an ideal choice for investors who are transitioning from the accumulation phase to income generation. Now, imagine this scenario. You wake up on the first day of every month knowing that thousands of dollars are about to hit your account, regardless of whether the market went up or down the previous month. That's the psychological power of monthly dividend income. It fundamentally transforms your relationship with money and gives you the confidence to make decisions based on what you want to do, not what you have to do to pay the bills. Let's move to the third pillar, the Vanguard High Dividend Yield ETF, with the ticker symbol VYM. If SCHD is all about quality dividend growth and JEPI is about high monthly income, then VYM is about bulletproof diversification. This fund holds over 560 different dividend-paying stocks, giving you exposure to a massive cross-section of the entire U.S. economy. VYM currently yields around 2.5% annually. Yes, I acknowledge it's lower than both SCHD and JEPI, but that's not the point of including VYM in this strategy. VYM's role in this 3 ETF approach is to provide stability and broad market exposure. It tracks the FTSE High Dividend Yield Index, which focuses on large-cap companies that pay above-average dividends. The fund's top holdings include giants like Broadcom, JP Morgan Chase, ExxonMobil, and Johnson & Johnson. What makes VYM special is its sheer diversification. With over 500 holdings weighted by market capitalization, you're not putting all your eggs in one basket. You're spreading your investment across financial services, technology, healthcare, consumer goods, energy, industrials, and more. This means if one sector takes a significant hit, your overall portfolio remains stable because you're diversified across the entire economy. The expense ratio for VYM is also incredibly low, at 0.06%, matching SCHD, and making it one of the most cost-efficient ways to gain exposure to high-quality dividend payers. Over the long term, these low fees compound in your favor, making a substantial difference in your total returns. Now here's where I bring it all together for you. How do you actually build a portfolio with these 3 ETFs that generates $15,000 per month? Let's do the math together. $15,000 per month equals $180,000 per year. To figure out how much capital you need, we divide your desired annual income by the average yield of your portfolio. If we allocate our portfolio strategically across these 3 ETFs, we can achieve a blended yield of around 5 to 6%. Let's say we aim for a blended yield of 5.5%. To generate $180,000 annually at a 5.5% yield, you would need a portfolio valued at approximately $3.27 million. Now, I know that sounds like a massive number, But stay with me, because this is where the real magic of this strategy happens. You don't need to have $3 million tomorrow morning. This is a long-term strategy built on consistency, discipline, and the extraordinary power of compound growth. Let's say you start with $50,000 today and commit to investing $2,000 every single month consistently. With an average annual return of 10%, including both capital appreciation and dividend reinvestment, your portfolio would grow to over $1 million in just 20 years. Keep going for another 10 years with the same discipline, and you're well over $2 million. The investors who reach true financial freedom aren't the ones who try to time the market perfectly or chase after the next hot stock. They're the ones who show up consistently, invest regularly, and let compound growth do the heavy lifting over time. Boring? Maybe. Effective? Absolutely. Let me share with you how I would allocate capital across these 3 ETFs. A smart allocation strategy might look like this: 40% in SCHD for dividend growth, 40% in JEPI for high monthly income, and 20% in VYM for diversification and stability. This gives you a balanced approach where you're capturing growth, income, and broad market exposure all in one portfolio. With this allocation, your blended yield would be approximately 5.6%. On a $3.2 million portfolio, that's roughly $180,000 per year, or $15,000 per month in dividend income. You'd be receiving quarterly dividends from SCHD and VYM, plus monthly dividends from JEPI, creating multiple income streams flowing throughout the year. But here's what makes this strategy truly powerful in my eyes: it's flexible. You can adjust your allocation based on your personal situation and where you are in your financial journey. If you're younger and still in the accumulation phase, you might tilt more heavily toward SCHD to maximize dividend growth over time. If you're closer to retirement and need immediate income to support your lifestyle, you might increase your allocation to JEPI for that higher monthly cash flow. And if you want maximum stability and diversification, you could boost your position in VYM. Now let's address the elephant in the room that many people don't want to talk about: taxes. Dividend income is taxable, and depending on your income level and tax bracket, you could be paying anywhere from 0% to 23.8% on qualified dividends. This is exactly why many smart investors hold these dividend ETFs in tax-advantaged accounts like Roth IRAs or traditional IRAs. In a Roth IRA, your dividends grow completely tax-free, and when you withdraw them in retirement, you pay 0 taxes. That's a game changer. If you're investing in a taxable brokerage account, you'll want to be strategic about tax efficiency. The good news is that qualified dividends are taxed at lower rates than ordinary income, which is one reason why these ETFs are so attractive. The dividends from SCHD, JEPI, and VYM are generally considered qualified, meaning they benefit from preferential tax treatment under current tax law. Here's another key insight I want to share with you. Reinvesting your dividends during the accumulation phase supercharges your results dramatically. When you automatically reinvest every dividend payment back into purchasing more shares, you're buying more income-producing assets. Those new shares generate their own dividends, which buy even more shares. This creates a compounding snowball effect that accelerates your wealth-building journey exponentially. Let me paint a clear picture for you. Imagine you're 25 years old and you start investing $500 per month into this 3 ETF portfolio. You commit to reinvesting all dividends without touching them. Fast forward 40 years to age 65. With a conservative average annual return of 9%, your portfolio would be worth approximately $3.6 million. At a 5.5% yield, that's nearly $200,000 per year in dividend income to fund your retirement lifestyle. But here's the secret that separates dreamers from achievers, and I can't stress this enough. You have to start. Not tomorrow when conditions are perfect, not next month when you have more money, but today. The single biggest enemy of wealth building isn't market crashes or economic recessions, it's procrastination. Every month you wait is a month of compound growth you'll never get back. The investors who build life-changing wealth are the ones who take action, even if they start small. Now, let's have an honest conversation about risk, because no investment is without risk, and it's crucial that you understand what you're getting into. The stock market can be volatile and unpredictable. There will be years when your portfolio drops in value, sometimes significantly. There will be moments when you question whether this strategy is working. But history shows us time and time again that over the long term, quality dividend-paying companies tend to recover and continue growing stronger. One of the biggest advantages of dividend investing is that it gives you income even when stock prices are falling. During the 2008 financial crisis, many dividend stocks cut their payouts significantly. But funds like VYM and SCHD focus on companies with strong balance sheets and sustainable dividends. These companies weathered the storm and continued paying shareholders throughout the crisis. Another risk to consider is concentration. While VYM gives you exposure to over 500 holdings, SCHD holds around 100 companies, and JEPI's portfolio is more concentrated in large-cap names. This means you won't have the same level of diversification as a total market index fund. However, the trade-off is higher income generation, which is exactly what we're aiming for with this strategy. There's also inflation risk to think about. If inflation runs higher than your dividend growth rate, your real purchasing power decreases over time. However, dividend investing gives you a fighting chance to not only preserve your wealth, but grow it faster than inflation, especially when you focus on quality dividend growth companies. So here's my question for you. Are you Team SCHD for that consistent dividend growth? Team JEPI for that juicy monthly income hitting your account? Or Team VYM for that rock-solid diversification across the market? Let me know in the comments, and let's keep building wealth together.